welcome. Today I'm joined by Ruchit Mehta, Head of Research at SBI Mutual Fund, and our CEO, Dhirendra Kumar, and we'll be diving into the newly launched SBI Quant Fund. Welcome, gentlemen.
Thank you.
Now, Ruchit, to begin with, what is the SBI Quant Fund all about, and how does it use quantitative models to make investment decisions? If you could elaborate on that.
Sure. So this is a product which relies on a framework that we have been working on for a good 8-10 years. We started our efforts way back in 2015 to create a framework that would enable us to understand better what was working in the markets, what was playing out, and what we should anticipate going forward. And the outcome of that was a framework that, at first stance, gave us an asset allocation framework, say between equities and debt. And then at the second stance was to look at it from a factor perspective. And was growth working or was value working, and so on and so forth. 2016, we went to what we call as a live mode, which is that we put our framework into a live market environment, no longer back testing for the past. And we said, let us test out how this works on a live market conditions. And we've been sort of working to fine tune it, enhance it, improve upon the framework. And today we are at a situation where we feel comfortable that the more framework is robust enough for us to be able to launch a product on this platform, and therefore provide the customers an opportunity to invest into what we would call as a rules-based or framework, right? The product framework is quite simple, right? So we look at that at every market condition, there are certain factors that drive it, right? If you look at the last few years, right, value has been a big factor, right? So value stocks have done phenomenally well. Whether it was a PSU rally or it was a rally in for certain types of banks and so on and so forth. And it was more of a value factor or a value tilt that was working. So across the industry, you would have seen that value-oriented funds did far better than growth or quality-oriented funds. And so every market cycle has a different factor that works, right? So how do you capture that, and how do you ensure that you are able to move from one factor to the other factor smoothly is something that this framework tries to capture. So this is a multi-factor fund which focuses on all the key 4 factors of growth, quality, momentum, and value.
All right. So multi-factor fund and quant funds are, as you mentioned, driven by data and algorithms. So can you walk us through the stock selection strategy of your fund and share some key factors or algorithms that drive its decisions?
Sure. At the heart of it, the framework uses what an analyst would do, right? So we wanted to make sure that we are using the process of selecting a stock based on what we would do as fundamental analyst, right? So what is the ROE of a company? What is the growth of the company? What are the earnings expectations? What are the valuations, etc. So we've looked at what are at the end of it core fundamental aspects that we would look at it as a human being, as a fundamental analyst. And from there we take it and say, okay, we want to focus on a product that is liquid, and therefore we've chosen the top 200 companies. Liquidity is one criteria. Also, the quality of data is a lot better, right? So the top 200 companies means that you have the large cap universe, and then you have within the mid cap the top 100 large mid cap that's there. Now, the way the framework works is that under each of the growth, value, quality, and momentum framework, there is a score that is assigned to every company, right? And it's a very simple 1:200, right? So based on the sub parameters of each factor, let's say, take example, so company A. Now, company A will have, let's say, a value score, a growth score, a momentum score, and a quality score. Now, then the next step is to say, okay, how do we weight each of those factors? Okay. And then internally, we do track 4 different indices. We have developed our own set of indices, which is very closely to some of the third-party external benchmarks that are there for growth, value, quality, momentum. And then the framework tells us that what factor should be given what weightage, right? Initially, way back in 2015, when we first started the framework, we said equal 25% weight, and then we let it drift. And over periods of time, we reset it when it hits certain boundary conditions. So let's say, for example, currently the framework would tell me that I should be roughly around 28, 29% into quality. So then my quality factor for every stock will have that weightage. So to simplify, right? So if quality has a 30% weight and value is a 20% weight, then the value factor in every security gets a 20% weight and the quality factor gets a 30% weight. Similarly for the other two parameters. Then I get a composite score, right? Once I have a composite score in place, again, I rank them with one being the highest and 200 being the lowest. And then I start allocating to the top security. So the first security gets the highest maximum weight, then the second one, then the third one. There is an overlay of liquidity in that. So, we look at the last 30 days liquidity. We have overlays for what is the maximum stock that you can buy in the portfolio. So 10% is the max weight. There is a maximum individual security level active weight, etc. So there are a lot of risk parameters built in. And basis that, we will construct the portfolio. So we'll start with stock number one and filtering based on the liquidity and all of the active weight consideration, we'll keep going down. Typically, we've seen that we have about 35, 40 stocks in the portfolio. So over the last history, with the maximum being about 70 and the minimum coming to around 25 stocks.
Right now, Dhirendra, coming to you from an
Yeah.
investor perspective, what are the key benefits of investing in a quant fund like SBI's, and how does it compare to traditional actively managed or index funds?
Index fund is very understandable. It's a no-brainer. You exactly know what you are getting into, and there's absolutely no, everything is predictable in terms of what the fund will be doing, not the performance. Actively managed fund, we know that you have entrusted your money to a person and he will take a call what to do. This is exactly opposite of that, because many a times in my 30 years of looking at fund management and meeting almost every fund manager, I can tell you that there are swings. It's fine to be objective, and most fund managers, to my understanding, they try to be objective to best of their ability. But the market is such a it is a place where it is very difficult to have we are proven right or wrong only with hindsight. And in between, so data driven decision making, if you can get close, and if this is something which can bring about a greater degree of objectivity, elimination of a human bias. I know time and again where people strongly believe in things, and they think that okay, this time it's different. And ability today, the computing ability have grown so dramatically that ability to process complex data, absorb all of it and make sense of it. And systematic risk management, anything that you can develop a framework and automate the process, start getting signal and act on it. So I think it's a very desirable framework. Only with time it will be proven that how it stacks up. But I am very hopeful that there are problems with index fund and there are advantages of index fund. There are problems of swings in performance of actively managed fund, and requires longer time frame, get greater understanding. Here is something which is more likely to in these times, and if it is going to be a dynamic one, it looks very promising.
Ruchit, like Dhirendra mentioned, markets are volatile and they evolve, and so do market patterns. So, how does your fund ensure its models stay relevant and adapt effectively to these changes? You did mention resetting weightages and all of that, but if you could elaborate on this.
Yeah. So the way the framework works is that for example, if there is a certain allocation to, let's say, the value factor, right? And if value keeps outperforming, we keep the weightage in value constant in the sense that we let it drift. Okay. I don't want to remain constant, let's say 25%. So let's say we started originally way back, we let it drift. But generally what happens is, right, over a reasonably long period of time, right, mean reversion does occur. Okay, one single factor does not outperform at any point in time, right? You will have periods in which the market, in a variety of manners, will kind of reset itself. And when we did our work on it, we found out that there was a boundary condition. So let's say on the upper side, 35%, so a plus 10% on 25, and on the lower side, a minus 8%, it's 17%. So whenever a single factor hits either the upper boundary or hits a lower boundary, we reset the portfolio to 25% of each factor. And then we start doing a sort of a reallocation to that. If I were to just say, give you an example, right? Just before COVID hit us, right? For a good 5 years, right? Quality as a factor was one of the best performing factors. And it had drifted up somewhat dramatically all the way up to the higher end of the spectrum. And somewhere around March of 2020, our framework told us that quality has hit the peak and it's probably a good time to reset. And we had reset everything to 25%. Subsequently, obviously, in hindsight, it looks like it was quite obvious, but then COVID hit us, the COVID meltdown happened, and value as a style did a massive outperformance, right? So because we reset and then we allowed drifting to happen post reset, we were able to capture those dynamic market conditions this time. The framework also reevaluates this on a month-end basis. So every month end, we keep reevaluating, run the numbers again, and then make the adjustments that are necessary. The other factor is, right, so while in a rules-based approach, it is good to let the framework run by itself and not have human intervention on a month-on-month basis. As a research team, we will keep evaluating the framework, right? So it's like this, right? You have a car engine, right? You let it run, right? But you keep paying attention to it. Keep paying attention to the noise that it makes, the sounds it makes, and see if there's a need to keep fine tuning it, right? Because we want to optimize the performance. So those are the things we'll do. Like in COVID, we learned the lessons of COVID. We saw how the framework performed in COVID. We try to make sure that other ways for us to fine tune it so that we can do a better performance. So those are the things that we'll keep evaluating.
I have two questions crossing my mind. One is that will the asset allocation model that you referred to initially, will it be reflected in this fund? And other thing, the second question is that you have growth, valuation, momentum, and quality. Something will get emphasized, or you will let it run. When do you change track? When do you reset?
Sure. Sure. So on the first aspect, the asset allocation framework was essentially done by us to sort of give us a view on whether we should be positive or negative on equities, right? I mean, classic old age question that gets asked of any investment houses is market kya lagta hai, right? I mean, and we've always had a challenge in giving a straightforward
That's
answer.
also the party question.
I know, and we've always been saying that, look, at SBI funds, our focus is more on bottom-up research-based stock picking, and if that is the case, then regardless of market, we'll be able to deliver returns, right? Now, obviously, some people keep pestering and asking, "Ki market kya lagta hai, market kya," and we didn't want to have an answer to that by saying that, look, as an individual, this is what I think of the markets. And I can also give you a view. I may be right or wrong, but sometimes I will struggle to give you a basis for my answer on that, right? So the asset allocation framework was one way of by which we can say, what should be the view on equities, right? Or let's say on non-equities. That helped us launch, say, the Balance Advantage Fund, right? Which is going overweight to underweight on equities. This fund says within the equity space, right? What should be my allocation? So this does not take asset allocation and framework outcome into question. So I will not be overweighting or
So you will be fully invested.
this will be fully invested. This will be 98+% invested into equities. The 1-2% is because general cash expenses of inflows, outflows, etc. But yeah, this will be fully invested into equity. So there's no asset allocation call per se. But yeah, there are interesting options, right? In future, could we launch an asset allocation framework fund where this is also input? It could be a very interesting aspect.
Yeah.
The second was that with regards to when do we reset, right? So as I said, when we originally started, so 2015, we said 25% is equal weight, right? And then we let the factors outperform and perform as they should be. Now, and we let it run every month, okay? And we keep retesting at the end of the month where it is. Now, at a point when it hits either the upper boundary, any one single factor, so let's say quality hit 35%, then we reset everything to 25. Or if let's say on the bottom, let's say value hit 17%, right? My lower end of my boundary. Then again, I reset everything. So on a month-on-month basis or maybe yearly basis, we will let the factors drift, the weightages drift as it should be. Only when we hit the upper and the lower end of the boundary conditions for any single factor, we will reset the portfolio back to 20 and then let it run again.
Who would you say is the ideal investor for SBI Quant Fund? What kind of investment goals or risk profiles would align well with this fund?
Sure. I think any investor who has direct experience of having invested into mutual funds and equity markets for a reasonable period of time can be a target for this fund. And the reason I say an experience of investing into equities, right, is because you need to have the experience of investing in a high risk asset, right? All said and done, any product in the equity market is going to be a higher risk product. Secondly, this is a different concept, right? Here, am working on a framework based approach, and therefore it is not easy for everyone to understand it, right? So therefore, an experienced investor, right? Let's say you've been investing in equities for at least 3 to 5 years, right? Then you will probably understand this better and have an ability to take, any movements or shocks in the portfolio as the markets keep evolving. So that's the one key aspect that. But the one thing I probably let the investor understand is that people think quant products are high risk products, right? And that's something that also was at the back of our minds when we were designing the framework. We think that our framework actually minimizes risk, right? So there is a focus on risk mitigation as well. Because we've kept those boundary conditions, we've focused on liquidity, we focused on active weight shares, etc., as much as a real portfolio manager would do, right? So we wanted the framework to think like an active portfolio manager, right? That how much can I overweight, how much can I underweight, how much are my boundary conditions, right? So therefore, there is a focused effort towards risk mitigation. Also, having all the four factors in place, make sure that you're not over reliant on one factor, right? So I'm not like a quant fund which relies on momentum. So if momentum goes out of flavor, it's not my fund will underperform. Maybe I will shift to something that is likely going to do better. So there's a lot of focus on risk mitigation, and therefore, as Dhiren was mentioning, right, between a passive strategy and a direct pure equity strategy, this sits somewhere in the between, right? It takes higher risk than a passive fund, but in some sense, it has better risk mitigation than actively managed fund. So therefore, it sits somewhere in the between over there.
Right. So then before we wrap up this chat, would you say this fund is more appropriate for data savvy analytical investors or for those looking to diversify through a disciplined, systematic investment approach?
Yes, for both, transparency and logic, it strikes a chord with many investors. Investors are looking for what will drive this fund, what this fund will never do, what this fund will always do, and, what to expect. And I think on that front, you have a far greater predictability based on what is going on. And also, the dynamic nature of this particular model, which being referred here, being used here, that momentum, growth, value, and four factors getting combined together, that makes it because many times something specific drives either momentum or growth or valuation, but here things will change, and the dynamic nature of this model, so it will be tested and proven over time. But I think it sounds very a systematic approach to this. So most investors looking forward to some systematic approach to investing, a diversified portfolio, and done with objectivity, and not throwing surprises, because many a times my biggest mutual fund disappointment over the last 2-3 decades has been when somebody just stops doing what is very basically expected of it, which is completely ruled out in this fund. In fact, I'll tell you that everybody think that index is a no-brainer. It'll get you instant diversification at low cost and something, but we have some problem in index as well. In year 2000, when technology went about dominating it, here was a sector dominance which was reflected in the excesses of the market, or the valuation of the technology stocks. Then they went about dominating, and every fund which was benchmarked to it actually went wrong. So hindsight is perfect. Here is something, if the dynamism is getting reflected, has been thought through, and hopefully it proves over time.
All right. With that, it's time for us to wrap up this insightful discussion. Thank you both of you for sharing your thoughts and perspective.
Thank you.
Thanks.
Thank you.